All righty, folks. You and I look at economic data. We talk economy, housing, money all the time. I talk about government data, CPI, PPI, PCE, blah, blah, blah. But you know what? Is the government lying to us? Is the data manipulated? Is it part of the story? Anna Kelly has gone deep. She just completed nearly a 3-hour session dissecting all the data. And we are lucky enough to have her highlight what she uncovered. Anna, is the government lying?
Yes. they are, and
Shocking.
shocking. So I think we have two problems trying to figure out where are we in the economy and where are things headed. And as investors, we all want to know where are rates going. That's the biggest question. Will it ever go back to where it was? And how do we keep making money in real estate? And the only way to really know that is to listen to what does the economic data say about where we are and where we're heading. And one, kind of like we've talked about on this show multiple times, the Fed president, Jerome Powell, at this point talks in Fed speak, and Greenspan was, really known for Fed speak, saying lots of things, and then people still go, huh? What did he say?
Yeah.
They don't want to tell you everything that's potentially negative because they don't want people to riot. I mean, that's the reality, right? So things like we talked about in video number 1, and we've talked about on this show before, Powell doesn't come out and say, too many of you are working and y'all make too much money. So we're going to keep raising rates so that we get more of you laid off and so that we get your wages to come down. So you stop spending money so we can get inflation down. What they're going to say is there's imbalances in the job market. We need to bring the jobs back in better balance. Well, what does that mean to the average Joe? They have no clue what that means, right? So one example is that with jobs. So we see and we hear multiple economists and also, regional bank presidents. So, those that are on the FOMC, that the open market committee of the Fed that determine rates, some of them have voting. They can vote that year, they rotate, and some of them don't. But basically, you have these 12 regional banks that are each made up of a bank president of the region: Kansas City, Dallas, Philadelphia. I think there's one in maybe Cincinnati, Ohio. So we've got these different presidents. They come out and say different things. Well, what are they all saying? The job market is what? The job market is strong. We have new jobs created. We have wage growth. We have low unemployment. So the reality is, historically, we do have low unemployment. But how is unemployment measured? How many people are not counted in unemployment, yet they've given up on working and they're just not in the labor force at all? That's not counted, right? And so
so let's talk about that. There's 2 metrics people can look at. There's U3, which is the 3.8%, and we'll get a new number on Friday. But to your point, there's also this thing called U6, right? U3 does not count people who are not looking, aka given up. U6 does. I've never seen U6 quoted by a news media. It's always U3.
Never. Absolutely. And they don't want you to understand, where things are really, because if you're worried about losing your job, yes, you'll stop spending, but people, if they see government spending and all these projects, and then their taxes are going to go up, and then they also are worried about losing their job, it can create some real backlash, from the American public when they're, in riots. I mean, quite frankly, that's what happens. But, when you look at employment, one of the examples in March, they came out and said, okay, we've created 303,000 jobs. The employment market is booming. All the headlines are booming economy.
Yeah.
We're going to have a soft landing. Everything's going to be great. And maybe we can handle higher inflation. And maybe the Fed is going to give up their rate hikes and live with higher inflation because we have this booming employment. But the reality is 2 things. One, the government does not come out and tell you how many jobs created were full-time versus part-time, how many jobs were government created rather than private sector created. Government jobs it means you're sucking money out of the economy because you're putting people in jobs for things like social services, right? Instead of the private sector booming, and therefore they're creating a bunch of private sector jobs. So that's two things. The other thing that they don't really tell you is how many net full-time jobs were created, not just how many, right? So I'll give you some just three real quick examples. So when you look at that 303,000 jobs, when you look at that number alone, you think, great, that's net job creation. But the vast majority of those jobs were actually part-time jobs. So what happens is before every recession, and every time except for once, a recession follows when this happens. People can no longer make ends meet. They're living check to check. They take on a second or third job. So some of these people are double and triple counted, working multiple jobs to make ends meet. So there is an actual chart that you can find on the Bureau of Labor Statistics, and they show you how many new part-time jobs versus full-time jobs. So the government knows the data, but they're not telling you the data. So that's why I'm saying they're lying to you. It's like the sin of omission, right? It's not that they're flat out telling you. They're just omitting the important part that
so let's push on
coming
that.
Down.
Yeah, let's push on that a little bit. So first off, that 303 number was dirty. You're absolutely right. When that came out, you didn't have to have an econ or an MBA to scratch that and realize it was a horrible number.
Yeah.
I think what the government and frankly the media knows is the average American won't scratch it.
Absolutely.
So it's not a lie. It's we're brainwashed to not question. I think that's what it is we're brainwashed not to question. So more on that 303, you're absolutely right. If you scratched it, like if you sneezed on it, you saw that we actually lost full-time jobs. Lost.
Absolutely.
Negative.
And so 2023, just to give you an actual number, the government said that we created over 600,000 jobs for the last 2 quarters of 2023. In reality, we lost 1.326 million full-time jobs net.
Yeah.
So, but we got lots of part-time jobs. Okay. So that's a huge difference. If you think my job is safe, so I'm spending money and I'm investing, in T-bonds or whatever, and I've got savings, right? And you suddenly are blindsided, you're hurting because you don't know the data, right? So
agree.
it definitely hurts people and keeps you in the dark. The other thing about that number, not only is it pointing to a recession, which they don't want you to know a recession could come, because they want you to think the economy's healthy so that you vote, right? Or whoever you think is going to keep the economy higher. That's part of it.
No, it's not about voting. It's not about voting.
Come on,
it's about spending. It's about spending. They want to keep consumers spending.
Well, they need to create some GDP, right? They want to create enough growth that you have a little more growth than you do inflation.
Right. So let's talk about the voting. Let's talk about the voting because I disagree entirely.
No, you don't.
Yeah, I do actually. So, well, I like
when we disagree. I'm just surprised.
Me too. So let's talk about the voting. So, my history, and I studied the consumer for 30 years.
Yeah.
In my history, a happy consumer, a content consumer, doesn't vote. Consumers only vote when they're angry. They're scared. You want to get a big turnout? Have the economy go in the shit before the election.
Well, that'll get you.
Well, okay.
That's what I mean. So let's say they allow a recession to happen. They tell you that you're losing your job, that a recession's around the corner, that the employment market is terrible. Now you're really worried. You're really concerned.
That's going to make you vote.
You vote out the incumbent.
Of course, you vote out there.
That's
so again, it's not about getting like if we have if the average public thinks we're in an okay economy, they're going to not vote so it's not about getting votes.
That's an interesting. It's actually about. We believe the same outcome, but yes, I didn't think about, to your point, how many people that think it's good just won't go vote.
Exactly. They're not going to vote. No, history says you can go back and look it up. When the economy is good, turnout is low. When there is a
Right. I
recession
see
or
what
the
you're saying.
economy is bad.
So you would say it's not that they're trying to buy votes, but they're trying to keep people from coming to vote them out.
Exactly. That is
So
exactly
we're on
what
the same page.
but
We're
it's
on
not
the
about
same
getting the vote.
page.
It's
So
actually the reverse of that.
I see what you mean. Yes, but the same outcome. What they're
No, I agree. Yes.
The incumbent party. This is part of why the economy always looks good in the fourth year of a presidency before the election, and then it tends to go in the crapper the next year.
Exactly.
Like, we have these cycles, right?
Yeah, exactly.
But to that point, they don't want you to know that the job market is weakening or that they're trying to take your
A
job.
scared
And
consumer is dangerous. It's dangerous, both for
absolutely,
the incumbents,
absolutely,
both for GDP. A
yeah,
scared consumer is,
absolutely,
I mean, that's where problems can come, right?
for sure. And the CBO, the Congressional Budget Office, they're looking out and placing their budget based upon where they see and need
Yep.
CPI and GDP and employment to go. And they're projecting unemployment up to about 5.4% over the next couple of
Really?
years, somewhere between 3.1 and 5.4%. So
That's
they say, sure, it could be low, but we think
3-1 to 5-4.
with the
Crazy.
65%, chance probability, it could go up to 5.4%. So they expect a little bit higher unemployment. Here's the other thing. If you look out past all the way out to 2034, a 10-year projection, Michael,
Wow.
they're expecting the average unemployment rate to be 4.1. So for it to spike this year,
Okay.
and then go back down, but to stay at 4.1 to 4.2 for a decade, which means higher unemployment than we're at today. Well, why would that happen? So again, there's things that they say about that. They want and need more immigration. And because we'll have more people working, we will have a higher unemployment rate. Those are the kind of things that they don't really tell you, that is really there buried in the data. The other thing is, when governments create more than 10% of the new full-time jobs that are created, not net, but total,
right, it
always points to a recession. The government last year created I believe it was 25.4, maybe 24.5% of all new full-time jobs were public sector jobs, because, well, one, it keeps GDP up just enough, even though they have private sector layoffs. They just want GDP to be just enough over inflation that it's not inflationary, but it's not recessionary either. So when you look at their data on GDP and CPI, they want to get CPI back to basically 2%. And they think it's going to take at least 5 years to get there. Okay. Wow. To really get there and stay there. But they're looking at a real GDP, inflation adjusted, over the next decade of an average of 1.8 to 1.9%. That's lower than what we've had. It's post 2009 growth. So they expect inflation to come back down. They need it down to pay off the interest on their debt. And they expect growth to slow substantially while you have higher unemployment. That tells you, Michael, what you and I have been saying for over a year and a half at this point: stagflation. Yeah. A very flat economy. Lower growth, higher inflation slightly, and higher unemployment. But they're not going to tell you that. And higher taxes. Absolutely.
Yuck.
So is the government lying to you? Yes, they are. So you've got to dig down beneath the hood and look into the data. And that's why, my little mini course that I did this last week was a 2-hour and 45-minute course, because you have to understand, where are we in an economic cycle, and how do governments behave when you're in that point of the economic cycle? It's not just about interest rates. They're trying to get you to this economy that just slowly grows, despite the fact that demographically, secularly, over the last 40 years, we've been on a declining, disinflationary path, where you need more and more and more government spending to create just a little more growth, so people feel like they're healthy. They feel like they have a job. They see wages growing, and they don't realize that on an inflation adjusted basis, they're treading water. They're living check to check, and they
Yeah.
wonder why can't they get ahead. So it's just more reason for us to be firm believers that if you really want to create wealth in an economy that is designed to barely get your wages up enough that you think you're growing, but allow enough inflation to get rid of government debt with cheaper money in the future, you can't rely on your salary, Michael. You have to go out and invest and create wealth on top of that. I want to give you one more stat that I pulled up, or actually two more things on employment that I pulled up that I go over into detail in this webinar that I did and recorded. But one of them is, if you look at, they took 1991 as kind of the benchmark to say, okay, where inflation is there is pretty historically middle. So let's take a 1991 wage and adjust it for inflation back to 1972, and then bring it forward for inflation up to 2019. Okay. So they did a study from 1972 to 2019. And they looked at what a production or managerial employee made. And on a dollar evened basis because of inflation, you made a little more than $24 an hour in 1972. And the same exact, I'm going to pull up the exact number and I'm going to tell you right now. The same exact salary in 2019 was the same exact amount. And what that means is inflation, its impact on wages is that you think your wages are going up, but they're actually staying the same. So the exact number, and I'm sorry, it was 1973, February of 1973, your real hourly wage was $23.24. March 2019, your real hourly inflation adjusted wage was exactly $23.24. So in over, a ballpark, about a 30-year period, a little more than that, you think you had wage growth because your salary said $40 versus 20, but real wages on an inflation adjusted basis keep you at exactly the same point while you think that you're growing your wealth. And so that's why the government lies to you, because they need you to not understand the reason their inflation target isn't 0 and it's 2, and actually it's 2.2 over the next decade. They need inflation to devalue the purchasing power of your money so that government debt is paid down with cheaper dollars into the future.
So let me ask you this.
That's the truth.
Let me ask you a question as a mom.
Yeah.
You're using the word lying. Shoot, I've used the word lying. I'm wondering if a better word might be manipulating. I'm just serious. I mean, I don't know if it's the same thing.
Deceit. It's both deceit.
Yeah, but I really think they're trying to manipulate by partial and all of that. And again, folks, we come on the show once a week. I do a daily show. You have to understand some simple economic terms like nominal and real, right? Nominal data versus real. What Anna just went through was all real, aka inflation adjusted.
Absolutely.
Nominal would be, I don't know, $14.73 and $52.19. Those are real numbers. You have to adjust everything for inflation. And then the last thing is, to your point, and I've said this 1,000 times, inflation is a feature, not bug.
Absolutely.
Do you know that?
And it has
Invest
been
like that. Yes.
And it has been, but people don't realize it because you see, I'm making more money than I was before. And so you think, wow, when I got started 20 years ago, I made $20 an hour and today I make $40 an hour. But you don't realize that when you adjust that for inflation, your $40 an hour today buys you the same exact amount of stuff that your $20 an hour did before.
Or less.
Which is why you don't, or less. Which is why you don't really feel rich, right? So even with, the headline of, so we talked about jobs and the fact that it's not as strong as we say. Also, 28 states out of 50 have statistically higher unemployment than they did last year, 25. So there's several economic rules that we've hit the threshold for technically being in a recession. Okay. So, and then we talk about wages. So, when you look at where are things going, we have higher inflation now than what we've had in my lifetime, right? I'll be 50 this year. I was born in 1974, and the inflation started kind of, running 2 years before I was born, and then, took till I was about 10 to really get a hold of things. But the headline is your wage growth has been amazing. Like everybody's wages continue to improve. But when your real cost of living has gone up at least 25% for everybody since COVID, since all of this started, at least.
Totally agree.
Your food, your housing, your insurance has gone up significantly more. Just your day-to-day stuff, okay, has gone up at least 25%. Wage growth over the last 3 years has not gone up 25%. And the sad thing about inflation is it very rarely mean reverses. So it's very rare that your insurance company is all of a sudden going to go, you know what? We charged you way too much. Now we're going to lower the amount that we're charging you for your premiums, right? Rent's reverting somewhat, but they can only go so far back because of higher insurance costs and things like that. So higher taxes and things like that. So you see that you have wage inflation and you're told, this is where the disconnect is and how people feel versus what they see in the news based, from all of the government speakers and talking heads and economists. You feel, and I hear it all the time from coaching students and from comments on our channel and on social media, why am I struggling and living check to check? Why is everybody else doing well, but I feel like I'm falling further and further behind? Because you are. The reality is you are. And that is the sad thing about inflation. It is a tax on the middle class. And so middle class, the wealth gaps have just grown and grown and grown over time because of inflation and being something the government's tried to make happen. And then it creates asset bubbles, and the people that know how to deal with it invest in hard assets that go up with inflation. This is why, I bought a single family house last week. Because I know the value is going to go up with inflation. And I think we're going to have a more inflationary decade than what we did in the last decade. And if you dig beneath the hood and you look at all the congressional budget reports and the bank regional reports, that they're expecting higher inflation and higher unemployment and lower GDP too. So the data shows exactly what we're saying. These are not just theories that we're coming up with. Hey, we think it's going to be stagflation. Now the markets and the news and people are starting to really go, Now that Jamie Dimon said it, like, Anna really might be right. This really could be, stagflation. So, the data shows that we are in for a lower growth decade. Agreed. And we are in for a higher inflationary decade, and Agreed. Your wages are not going to keep up. And so you have to figure out when we have a recession, and let me just tell you this last thing, the leading economic indicators have been recessionary for months. We had 2 quarters of negative GDP and the NBER didn't declare a recession. Now we don't have 2 quarters of negative GDP, but wages are down. Wages are recessionary. Our gross domestic income is recessionary. Our net national savings is recessionary. Our leading economic indicators are recessionary. Manufacturing just came out and said that, they're laying off a bunch of people, and their level of production at 49.9 PMI is recessionary every time. So we have been in recessionary conditions, but the government's not going to call a recession. Why? They want you to think everything is good. And the reality is we know the way you feel that it's not. So you've got to really watch the data. You've got to see where it's going. And then you've got to question it. Yeah, absolutely. If we have a declared recession, even if we don't, right? So many of your competitors have quit buying. They say prices are too high and, interest rates are too high. So you have less competition, which means there's more opportunity. And the more fear that comes as job layoffs continue and unemployment ticks up and we start to see more of this economic pain actually come out in the forefront, you're going to have a recession, and you're going to have people say, you are crazy for buying real estate right now. This is the worst time possible. I love hearing that. Yeah. And when that fear comes, that's your maximum point of opportunity. So the bad news is the government is not going to save you. The economy isn't going to be great over the next decade. But the good news is if you understand the data and you start digging a little deeper, you'll understand when it's clear that not only are we contracting, but that we've hit a trough, and it's clear that the government starts to cut rates and do things to produce a recovery, and you start to have some recovery period. You know, this is the time to go buy real estate that over time with inflation is going to continue to go up in value. And so it's not all about doom and gloom. It's about knowing the reality isn't good so that you can make a decision. Am I going to let my future be more of the same with what the government's providing our economy? Or am I going to do something about it and change it? So, you know, my heart in sharing this and in doing this show with you every week, as I know yours is as well, and in putting on this webinar and making the recordings available for people to understand it, is so that you can understand the reality of where we really are, not the lies that the media and government agencies tell you, and that you can then say, I get it. So what am I going to do about it?
Yes.
And then talk about, if we have a deep recession, what do you do? If we have more stagflation, what do you do? If we have more inflation, what do you do? If we have a war, what do you do? And there's history shows us what to invest in, when to invest in it, what not to invest in, and then how to shift our strategies, for example, between value add and buy and hold, based on what we know has happened and where we most likely are headed.
Love it. Love it. Anna, you are amazing. Going through 2 hours and 45 minutes. We'll get the link if anybody wants to check it out. Thank you for being here. You're amazing. I can't wait to see where this all goes. And congrats on your single family home. That's amazing.
Thank you. I'm excited. My first single family home, other than a vacation rental, that I bought in 5 years.
That's telling you something, folks. Stop for those singles. Look for motivated sellers. They are out there. Take care, Anna.
Thanks.